The digital banking space across the world is flourishing, with an astronomical number of transactions. It was estimated at a value of $12 billion in 2020 and is projected to reach the size of $30 billion by 2026, which is an impressive growth rate of nearly 16%. To take advantage of this lucrative market, neobanks have been rushing to serve as many customers as possible. While they have been successful in establishing a large customer base, many of these banks are failing to meet AML and KYC requirements. It seems that the German neobank N26 just received yet another slap on the wrist from BaFin, but it is by no means the only neobank under the scrutiny of the regulators. Monzo is also under investigation by the British financial regulator for its insufficient AML checks. So why do neobanks seem to be in this endless cat and mouse game with the regulators? Good morning everyone, this is Mark from Payment Genes, and today it's all about payments. In all fairness, this news doesn't really come as a surprise, considering the massive digitalization wave in 2020 and the ensuing surge in fraudulent online activity. That being said, there are a number of factors that could have led to neobanks being used as a tool for money laundering and online fraud. From our perspective, the main reason neobanks are constantly in regulatory hot water is that the current regulations are mostly tailored to the traditional paper-driven banks. But as companies are growing to become digital, both them and the regulators are struggling to impose sufficient regulations that cater to online onboarding. In a race to be the first and the largest, neobanks are focused on increasing market share and tapping into new markets. In response to the rising costs, some of them are engaging in cost cutting when it comes to building sophisticated compliance departments. Because the battle to gain the largest market share is so fierce, banks are racing to have the quickest online onboarding as customers have high expectations and little patience when setting up new accounts. And it's not too hard to figure out that this convenience probably comes at the cost of security measures. To truly become mainstream, neobanks' approach to money laundering detection and prevention needs a change. And the recent news certainly gives us many lessons to learn from. One way to improve governance would be by building an extensive and experienced team of financial analysts and risk managers. Payment Genes also experiences a rise in demand for finding top-notch financial experts. While we understand that having a quick, frictionless KYC process is ideal from a customer's perspective, adoption of virtual KYC checks can significantly reduce risk and repel fraudsters. That being said, AI-driven KYC and AML solutions can be a vital part in cutting down liability. Not only does it reduce the staff's workload, it also ensures high accuracy and low false alert rates due to its risk-based approach. Finally, it is admittedly tough to find a balance between a frictionless yet secure and risk-free customer onboarding process. Hence, we are curious to see which neobank will be the first to find that perfect balance. But the question remains, are neobanks not doing enough to ensure governance, or is it the regulators' fault for lagging behind? We are curious to hear your thoughts on this one. If you like this video, don't forget to like and subscribe for a new video every Monday. For now, I'd like to thank you all again for watching. I'm looking forward to see you all again next week. Cheers, bye-bye!